Good morning, dear students. Our second module, capital structure. What is capital structure? It is a mix of debt and equity that a company finances its operations and growth. What is debt? That is the borrowed instruments of the company. Examples of debt instruments are loans from a bank or financial institution, debentures issued by the company, bonds issued by the company. These debt instruments carries a fixed rate of interest. And what is equity? Equity shares, preference shares, retained earnings, all these they comprises of equity. It is also known as owner's fund or net worth. So, what is capital structure means? It is a mix of debt instruments and equity. So, what is an optimal capital structure? So, that optimal capital structure balances risk, return, and minimizes the cost of capital and maximizes the value of the firm. So, that is the optimal capital structure. So the components of capital structure, the graphical representation of the components of capital structure. First part is equity part, and second part is debt part. The first part, shareholders fund, commonly known as shareholders fund. It consists of equity capital, preference share capital, retained earnings. And the second part, debt, means commonly known as borrowed fund. It consists of debentures, term loans, and public deposits. So the capital structure, the graphical representation, major part equity share capital, then preferred stock, then debt and other sources. That is a picture, graphical representation of the capital structure. And what is capital structure? What are the internal and external factors influencing capital structure? So the meaning already mentioned, it is two words, capital and structure. Capital refers to the investments of funds in business, while structure means arrangement of different components in proper proportion. So capital structure means financing mix of a company. It refers to the proportion of different securities raised by a firm for long-term finance. And the factors influencing capital structure, both internal and external factors affects the capital structure. So we can move on to the what are the internal factors which affects the capital structure. The first one is size and nature of the business. So the first part is size and nature of the business. So the size, if it is a small scale or it is a large scale or it is a medium scale, so that depends upon the capital structure. That is internally affects the functions of a company. So the size of a business has great impact on its capital structure. So trading concerns raise capital by issue of equity as well as preference shares as they require more working capital. Then small companies have limited capacity to raise funds from external sources. Large companies possess huge investments, so they can issue debentures by offering securities of fixed assets such as land, machinery, etc. On mortgage of these instruments, they are issuing debentures. Such companies prefer to raise funds by issuing equity shares along with the debentures. That is, large companies issues both debt instruments and equity instruments. So, size of the organization, size and nature of the business internally affects the capital structure. So, if it is a small scale industry, they issue equity shares as well as preference shares. If a company is large scale business, it is running on, so they require both debt and equity funds. Capital gearing. The ratio between debt to capital and equity capital is called capital gearing. So, what is capital gearing? It is a ratio between debt and equity. It is high gearing when the proportion of debt to capital is higher than the equity capital. So, when the capital gearing ratio is higher, that means the debt to capital is more than that of equity capital. When the gearing ratio is low, that means the debt to capital is low as compared to the equity share capital. In order to protect the interest of equity shareholders, the company usually uses proper mix of various types of securities in its capital structure. The third one is requirement of capital. At the initial stage, the company cannot raise its capital by issuing of equity shares because there is considerable risk involved, and hence it is preferred by issue of equity shares. Later on, for its expansion and modernization, the company may issue other types of securities such as debentures, public deposits, etc. Then third one, adequate earnings and cash position. Developed companies with stable earnings utilize large amount of debt capital in their capital structure as they can pay a fixed rate of interest. Companies with unstable earnings should not opt for debt in their capital structure as they may face difficulty in paying the fixed amount of interest. So the next internal factor which affects the capital structure is future plans and development. So capital structure is designed by the management keeping in mind the future development and expansion plans. Equity shares can be issued in the initial stages, whereas debentures and preference shares may be issued in future to finance developmental plans. Next one, period of finance. While framing capital structure, the period of finance is needed. It is also considered. If funds are required on a regular basis, the company should raise it through issue of equity shares. If the funds required as for a smaller period of time, they issue debentures or preference shares. Trading on equity. What is trading on equity? The use of borrowed capital for financing a firm is known as trading on equity. That means if the capital structure consists of borrowed funds, so at that time we can say the feature trading on equity. If the rate of interest on debt is lower than the rate of earnings of the company, the equity shareholders get additional dividend. This increases the credit worthiness of the company and the company is able to raise further loan at a lower rate of interest. On the other hand, if the company's earnings are not sufficient, it may lead to financial crisis as the interest on debt has to be paid even in case of loss. The entire earning may exhaust in payment of interest. In this case, no dividend can be declared by the company. If no dividend can be declared by the company, it adversely affects the creditworthiness of the company. Thus, trading on equity is double-edged sword. It may increase the income of the shareholder if things head in proper direction. On the other hand, it increases the risk of loss under unfavorable conditions. Then attitude of management. Capital structure is influenced by the attitude of the persons in the management. If the management wishes to have exclusive control over the company, they raise capital only through preference shares and debt capital. Since the holder of such shares do not enjoy the voting right, thereby cannot interfere the management of the company. And the next one is growth of business firm. Capital requirement of a firm depends upon the stage of development. At the initial stage, the source of finance is mostly equity shares and short-term loans. As the stage progresses, the requirement increases and funds are protected by issuing the debentures and preference shares. Next one, external factors. Which are the external factors affects the capital structure? The market conditions. Various methods of financing should be considered depending upon the prevailing market conditions. If the share market is in a declining situation, the company should raise funds by issuing debts. On the other hand, during the period of boom in the share market, the company should raise funds by issuing equity shares. The next one is attitude of investors. Attitude of investors also plays an important role in determination of capital structure. If the investors prefer to take risk and expect high returns, they invest in equity shares. If the investors prefer to earn safe and assured income and are not ready to take risk, they invest in preference shares or in debentures. The third one is government rules and regulations. According to SEBI, the normal debt equity ratio is 2:1. However, in case of large capital intensive projects, the permitted ratio is 3:1. Government provides aid and concession to small industrial projects to raise more debt capital. The next factor is rate of interest. Capital structure depends upon the rate of interest prevailing in the market. If the rate of interest is higher, firms delay debt financing. Conversely, if the rate of interest is lower, firms will opt for debt financing. The next one is competition. The company which faces cutthroat competition should raise funds by issuing equity shares as their earnings are not certain and adequate. However, the company which has monopoly in the market may issue debt capital because of certainty of earnings. Then the next one is cost of capital. That is also indirectly affect the, or that is an external factor which affects the debt capital structure. Cost of capital. What is cost of capital? It is the minimum return expected by its suppliers or the investors. The expected return depends upon the degree of risk. In case of debt holder, the rate of risk is assumed by equity shareholders than the debt holders. In case of shareholders, rate of dividend is not fixed and their capital is repaid only when the company is liquidated. Thus, debt is a cheaper source of capital than equity. The preferred share capital is also cheaper but not cheap as debt. However, the company cannot minimize cost of capital by employing only debt, as debt becomes more expensive beyond a particular point due to the increased risk of excessive debt of risk. Next one is attitude of financial institutions. Attitude of financial institutions also externally affects the capital structure. They determine the capital structure. Sorry, it will also determine the capital structure. If financial institutions prescribe high terms of lending, then the company should move to other source of financing. However, if financial institutions prescribe easy terms of lending, the company should obtain funds from such institutions. So the last factor which affects the capital structure externally is taxation. Interest paid against debt is tax deductible expenditure, whereas dividend is not considered as tax deductible expenditure for the company. So these are the external factors which affects the company's capital structure. Thank you.